get into the advisory now and have a look at what the federal budget could mean for your SMSF. Joining me is Liam Shorte from Sonus Wealth. Good to see you, Liam. You say don't panic. There are a lot of people panicking out there about these proposed changes to CGT, though.
Yeah, because normally when there's changes, the government are letting us know, they're leaking it well in advance and we have a good idea what's going on. But this time they seem to have left the decisions to the last moment. I think they'd run a lot of different scenarios, and then based on the fact that the Iran war is still going, they've sort of left it to the last moment to finalize what they're going to do. So all I'm saying to people is don't really panic. The first thing we need to see, if there are CGT changes that come out on Tuesday, and more than likely there will be, first thing we need to check is, do they apply just to personal, or will they apply to personal and superannuation held assets? That's an important detail because they're not always done in line with each other, and then the outcome will decide whether the strategic decision to hold growth assets in super makes sense going forward. If we're talking about reducing the personal capital gains tax discount and leaving the superannuation, then superannuation is going to be a lot more attractive. If we're talking about bringing in some form of the indexation that used to be there in the 90s, then that may result in holding assets in your personal name being a better option depending on inflation over the time. So please don't go rushing out selling stuff just because you want to sell it. But if you have shares with a big capital gain that you're planning to do some sales before the end of the tax year, then you might hedge your bet before Tuesday and sell 50% of them before the budget and 50% afterwards.
Whew. All right. That's a lot of maths to do in only a couple of days. So if you knew the $2 million transfer balance cap, what are you meant to do?
Right. So I've got clients whose birthdays are in May and June. So naturally they'd love to get into pension phase at 65, or if they've made a conditional release. And we're just saying, look, because we know that the pension cap of 2 million is going to rise to 2.1 million on the 1st of July, it might be worth just holding off. Don't start your pension in May or June. Hold off till the 1st of July and start with up to a $2.1 million transfer to pension phase. The other reason for doing that is to start a pension now, you must revalue all of the assets on the day the pension starts. So that's basically doing a whole set of accounts in May or June when you're going to have to do it again on the 30th of July. So save yourself the cost of the two and just set the pension up on the 1st of July.
And so with that, in the notice of intent to claim, you delay that, right?
So this is if you're putting money in for a deduction for your superannuation. Let's say you put a lump sum, your employer's put in 15 and you're going to put in another 15 yourself. Just be careful. It's often better to wait until after the end of the tax year and just see exactly what your employer put in, because you'll find some employers who desperately want an extra deduction might sneak in an extra bit of super before the 30th of June, especially with this payday super coming in on the 1st of July. So just be careful that you don't exceed your 30,000 limit by being too aggressive. Always leave a little buffer as well. But my preference is you don't have to put the notice of intent in until you're doing your 2026 taxes. So maybe just leave it until after July, see what's gone into your super fund, check your MyGov, and then do your notice of intent, and give that to your tax agent before you claim you do your personal taxes.
All right, it's the 8th of May. We're going to get to the 30th of June sooner than we know. If you want to put more into those concessional caps, the 5-year period, what's the advice, Liam?
Yeah, so look, this is a rolling 5-year period. So if you haven't used your full limits in previous years and your balance is less than 500,000, you can still use the five previous years. But because it's rolling, that means that any unused contributions from the 2021 financial year, they will be lost as of the 30th of June this year. So if you've got a bit of extra money, you'd like a tax deduction, and your balance is under 500,000, think about putting some extra money into super before the 30th of June, so that option is not lost in the future.
All right, your question of the week. I always love these, although I want you to do one time for those of us that don't have husbands, Liam. You need to be looking out for those of us that have to pay everything themselves. But can a husband accept in specie contributions as non-concessional contributions from his wife in SMSF? What's the answer?
Yeah, so anybody can make a contribution, and then you decide who that contribution is allotted to in your SMSF. So we often find where somebody has built up a lot of shares from being with a group like Macquarie or AMP or NAB. They've had employee shares, they've vested and they're in their names. They want to keep them, but they want to build up their spouse's balance. So yes, you can, but what you can't do is you can't put, say, 100 shares in and allocate them 50-50 to each of you. Each parcel of shares must be allocated to one member at the time that it enters. So if you did have 100 shares, you wanted to transfer them into your super fund, but you wanted them to split them between a husband and wife, then you just do two separate parcels. Do two off-market transfer forms, 50 to one, 50 to the other, or whatever mix you want. But don't think that you can put them in and then choose afterwards.